My name is Kusoji, Asian EM Market Strategist. Before we start, please note that this event is for Morgan Stanley institutional clients and financial advisors only. It is not for members of press. If you are a member of the press, please log off and reach out separately. Please also note that this webcast and your questions may be recorded. Today, we have Rajeev Sibal, Senior Global Economist, Jonathan Garner, Chief Asia and Emerging Markets Equity Strategist, Laura Wang, Chief China Equity Strategist, and Jenny Zheng, China Economist. During this session, you can send the questions at any time from the Ask a Question text box. First up, we have Rajeev today online to share the new Fed outlook and also how data is tracking on the ground. Over to you, Rajeev.
Hey, good afternoon, everyone, and good morning for those of you in the Middle East with me. I wanted to kind of give you a little bit of an update on what we're seeing in the economy globally, but also I'm going to start really with the U.S. because we view that the U.S. is driving the outlook for the next couple of quarters in terms of risk sentiment. The Federal Reserve has been in a difficult position. Markets have been volatile in terms of pricing Fed expectations. And Morgan Stanley, unfortunately, similarly, has been in a similar boat in that we found it difficult to forecast the Fed over the past couple months. And I'll explain to you why that's been happening. Our call now is very much in line with market pricing for June and September. But those of you that are close followers of Morgan Stanley economics research will see that we had some debates of whether or not the Fed would be cutting in December and January. And the timing around that is really linked to the data dependency. We've for some months now been highlighting that the first two quarters and the last meeting of 2025 and the first two quarters of 2026 are going to be very difficult to forecast because the Fed's reaction function is shifting between employment and inflation. And so in Jackson Hole last year, when the Fed kind of pre-announced that they were going to start cutting, it was indication to the market that the Fed was very much focused on employment. And in line with Morgan Stanley forecast, non-farm payrolls started to trend much, much lower. In fact, I can show you the non-farm payroll prints of recent months have been trending much, much lower towards an average of near 50,000. And you can see that in this image here on the left with the blue bars, and the 3-month moving average is the yellow. And our forecast for 2025 at the beginning of the year had very much been for a deceleration of non-farm payrolls towards the zero level. The problem with just the payrolls is that the unemployment rate in the United States has been fluctuating quite a bit. And unemployment started to move a little bit higher when we initially got some of those weak data points in non-farm payrolls in Q3 last year. What we saw, and that's when the unemployment rate went higher, we saw that the Fed was cutting interest rates. What we saw in the non-farm payrolls last week, however, was that the unemployment rate got revised lower. And a lot of this has to do with population dynamics in the United States. Just like a few years ago when we were having upside surprises to the labor market as U.S. population was increasing, in 2025 and 2026, we're similarly experiencing downside surprises to the U.S. labor market because the U.S. population growth rate is shrinking to almost zero. 2 years ago, the United States was having in the region of 3 million new immigrants a year, and now that has fallen to zero. And the implication of that is that you get slower job growth, which you're seeing in the non-farm payrolls, but it also means that unemployment doesn't necessarily move as much as you would expect when non-farm payrolls is this week. And so what we saw in the non-farm payroll data in January for the December outcomes was that unemployment fell back really, really low, and previous months were revised lower. And so the implication with unemployment being below 4.5 and down to kind of that 4.3 level is that the Fed probably needs to start shifting their focus away from employment towards inflation. And you can see that the inflation, which is the chart on the right, is going to remain elevated for a few more months. And so as a result, both the market and Morgan Stanley, and I'll shift back to my original chart, have pushed interest rate cuts from the Fed out to June and September. And the rationale for that is basically that if the unemployment rate is really low, then the Fed is going to be focused on inflation. And this could change over the next few months again. It's going to be very dependent on the data that we get. If you get some downside surprise in inflation, you could see those cuts pull forward. If you get upside surprise in the unemployment rate, you could see those cuts pull forward. The data dependency is going to be the name of the game in 2025. Now, equities seemingly have decided that this does not matter as much, and that may be the right answer for a general risk perspective, because you're really talking about two cuts, and this is a matter of when. The Fed median dot plot has one cut, so even if you get two, you're getting more than the Fed is currently projecting. And so in that kind of environment, equities seemingly have started to ignore a little bit of the noise. But for fixed income and FX, this does continue to matter. Where the question will lie is how strong is U.S. growth over the next couple of quarters, because the construct of U.S. growth will determine what the Fed path looks like. And so if you see on the right-hand side on this chart, growth was very strong in Q2 and Q3 last year, but a lot of that strength came from inventories and notably net exports. That net exports is not a stable growth indicator. It's just showing volatility around tariffs. As that yellow bar tracks down, we should expect growth to decelerate, not to a low level, but just to a kind of a trend consumption level, which is where these green bars are sitting at. And that's just around that 2% level of growth. And that's what we're forecasting for the next few quarters. Now, that's the baseline. And in that kind of world, we would be in line with market pricing that the cuts come in June and September. The questions come, and this is where it becomes really interesting, is if we have strong growth but low inflation, is that an indicator of productivity? Because if productivity is increasing in the United States, as you can see on the left-hand side, the Fed would be in a better position to cut interest rates earlier. If, however, growth remains really strong and we don't get the productivity boost, there's a risk that the Fed may actually have to hike rates, or the Fed won't be able to cut rates as expected, which is this blue bar. And the answer to that question, I think, is very important for equities. And I think we will better understand the answer to that question after we finish getting the data after the government shutdown and see what Q1 looks like. And so I think, right now, the baseline for the Fed is shifted to June and September, but that baseline very well may change over the next few months, depending on this path of which direction we're headed. Now, equities are very much, I think, looking forward to the yellow line, and the risk to equities might be that we're a little bit more on the blue line, or that growth is not as strong as expected. But for now, the answer economically to this question probably will take a couple more months to answer. And I think this is important not only for U.S., but also for global risk. A lot of our call globally was that as the Fed could start cutting rates, it could help lower real interest rates in other economies, particularly in Asia, in emerging markets, and in Europe. And a lower real rate in those economies allowed for a domestic demand cycle to take place. And so the path of the Fed will really have a translation effect in terms of when other central banks can cut interest rates and what the U.S. demand may mean for the export-oriented economies that exist in the world. So maybe I'll stop there. I've been speaking for a little bit over 5 minutes, and hand it over to Jonathan, who maybe can take what this means in a risk context.
Sure. So thank you very much, Rajiv, and Happy New Year to everybody. I'll just also share a screen here on a note that we put out right at the start of the week, which is on performance early in 2026. So we do this every year as an exercise. And the good news, we'll start with the good news, is that markets are up. Almost all markets and almost all sectors are up. And when you look at this on a sort of a statistical basis, albeit, of course, we only have maybe 35, 40 years of history, markets where we're up in the first 5 trading days, and here we're looking at EM, it's about like 60% plus of the observations that the year as a whole is a positive one for returns. Whereas you see on the right-hand side, there are obviously fewer years where we start off down, but it slightly edges it to being a bad year if you start off down. So we've started off up. And in fact, if you look at Japan, and this is topics, it's even stronger. Because obviously over the famous 20 years where Japan was not performing well, we often started down. These distributions are more matched, but actually starting up for Japan is about a 2/3 hit rate for the year as a whole, being positive. So that's good. And if you look at the performance, it's led again by Korea, skewed to semiconductors, defense industrials, and Korea value up. Smaller markets are also working, like Colombia, Peru, Turkey, Greece, but then another very large one, Taiwan. And then the underperformers are in Australia, parts of ASEAN, and India notably is failing to rally. So we do mention in this piece that we put out that that's not our view. We think the cyclical recovery in India is already underway, and we do have a moderate overweight on India, but that's clearly challenged with early market pricing. Our constructive views on Japan in particular are coming to fruition. Now here, if we look at the sector performance, it's very striking just how well semiconductors and memory names are going. And so that's in line with our bottom-up analysts' view. We went into this year broadly neutral on this sector. AI demand is clearly still very present. There's a lot of excitement about the IT sector in relation to China AI as well. Notice on the far right here that upstream energy is underperforming. Despite some of the geopolitical risk events that are happening, we've actually had a cut in our Brent oil price forecast from Martin Ratz, our analyst in London, and the team. We're expecting a weak market for Brent, $57.50 a barrel average for 26. The market is very well supplied. There's a transition, obviously, to other forms of automotive technology that aren't so oil intensive. And that is a key underweight for us. So it is our largest underweight energy. Materials, very diverse performance. Obviously, gold and precious metals doing well. Some other materials likewise. And in Japan, a few little points to notice here. Banks have started well. Some parts of machinery, particularly things that are geared to the industrial defense cycle. I notice retail trade doing quite badly, and that is related to China-Japan trade tensions, which are underway. So inbound tourism stocks and some consumer stocks in Japan generally are not performing well. Now, within all of this good news, I do want to highlight that geopolitical risks are very elevated. So over the holiday period, we had action by the US on Venezuela. We have those tensions between China and Japan. We had issues between UAE and Saudi Arabia over Yemen. We've got an ongoing situation in Iran that has the potential to change the narrative for the Middle East. It is noteworthy that if you look at FX volatility, it's actually been declining, including for the Taiwan dollar. We just have on this chart that hopefully you can see here a few spikes in Taiwan dollar 1-month option implied volatility around Nancy Pelosi, the former speaker's visit to Taiwan, the Taiwan presidential election in early 24, and obviously Liberation Day last year. But the market at the moment is pricing currency volatility lower, including for Taiwan. And we just leave that question hanging somewhat. In a follow-up Pulse note yesterday, we mentioned how low VIX is in the US, and rate volatility is also low. Over the course of yesterday, actually, VIX rose significantly. So we are starting to see it just really in the last 24, 48 hours, more of a response from macro markets to this constellation of geopolitical risks. But there's also plenty of idiosyncratic risks going on inside the United States itself over the Federal Reserve, over monetary policy, and indeed micro initiatives from the administration affecting some quite large sectors in the US market itself. So it is, in summary, a good start for the year. We shouldn't sort of negate that. That's the good news. But be careful. And overall, we're continuing to expect, as we say in the title here, a volatile year in 26. So our overall theme for the year is a robust approach for an uncertain world, making sure that your portfolio is going to be able to survive some quite significant swings through the course of the year. And that's it from me. I'll stop the share there. And thank you, Crystal. Back to you.
Thanks very much, Rajiv and Jonathan. Now we are shifting to China before we take any questions for the two speakers. China has performed very well this year, and then today we have Laura as a speaker to share her outlook for 2026.
Thank you very much, Crystal, and thank you for this opportunity to talk to all of our investors online. Yes, we remain cautiously optimistic towards Chinese equities coming into 2026, we actually see quite positive and strong liquidity support for both the onshore Asia market and for the offshore Hong Kong market. And we'll talk about those two markets separately. For the onshore Asia market, actually, we've been highlighting since late last year that there is a very clear trend of bond allocation moving gradually into equity allocation. And also we are noticing that for retail investors or for the general households in China who used to actually deposit cash for lack of better investment opportunities and who were attracted by relatively higher interest rate about 3-4 years ago. And these investors actually are also gradually moving their term deposit cash into the equity market allocation as we speak. If we think about the onshore treasury bond yield, the 10-year bond yield and the 30-year bond yields have both been picking up since November. I think partially that reflects somewhat improving outlook expected by the institutional investors onshore, but I also take that as a sign that the onshore regulators and policymakers are actually waiting to see more bond allocations being allocated into the equity part of the universe. And then we should not ignore insurance buying. Insurance companies have been doing extremely well, and insurance as a sector is something that we recommend you to get exposure to in your China portfolio. The insurance companies have been doing extremely well, and their year-on-year premium sales actually have also been picking up very nicely. Insurance companies have also been guided by onshore regulators to gradually increase their equity allocation. So we actually see a combination of premium sales pickup as well as the gradual increase of equity allocation as a percentage of the insurance portfolio as a strong catalyst for money from insurance companies into the equity allocation. So with all these three combined, we think the liquidity support for Asia market will be very strong. And also thinking about the opportunity set, which is very much in the categories of automation, robotics, biotech, and high-end manufacturing. Those are the unique opportunities that would be exclusively available in the Asia market. We think the outlook continue to be quite strong. But we do advise against some conventional, traditional consumer sectors such as staples, and we do not recommend investors to actually put money into the property sectors because we still see very heavy deflationary pressure, and those pressures are particularly casting some doubts on some of these Asia sectors. And for the Hong Kong market, actually, we see a very strong start of the year in the IPO market with 11 IPOs so far, and these companies achieving on average more than 30% of first day stock price increase. So I think that's been attracting a lot of institutional investors from all over the world. And then secondly, CNY against US dollar has been appreciating gradually, and that has also particularly breaking level 7. So that has also served as a strong catalyst for foreign investors to look at Chinese assets. Our China economics team, I think later Jenny could potentially be talking about this as well, recently revised their CNY USD forecast, and they are at least expecting minor, more deep appreciation of CNY against US dollar for the first quarter of this year. So I think that fund flow support from foreign investors attracted by the high quality IPOs in the market, as well as the rising attractiveness of Chinese assets in general, would serve as a strong catalyst. I think just very quickly, a quick comment on the margin financing tightening that was announced yesterday by onshore regulators. So what had happened is that we are seeing record high trading volume in the Asia market, approaching 4 trillion RMB, the highest ever. And also the margin financing balance is also making new record high in the Asia trading history, around $380 billion US dollars. So what had happened is that the regulators announced for the margin financing collateral ratio, they are increasing that collateral ratio requirement from 80% to reduce that from 100% to 80%. And actually, as a result, the leverage that would be tapped into by margin financing investors would effectively be smaller versus before. We take this as a very proactive action by the regulators to try to tame some of that overheatedness in the A-share market. We published this Morgan Stanley proprietary A-share sentiment index on a weekly basis. And as early as January the 6th, actually our Morgan Stanley A-share sentiment index had already indicated overheating sign. And the past Monday, this index, which remained range bound somewhere, the range should be 0 to 100%. The past Monday on January the 12th, our A-share sentiment index actually hit 93%, which is extremely high. So we were not really surprised by this, but the sort of the tightening or taming of the regulators of the A-share sentiment. But as I said earlier, we think the main liquidity contributor comes from the bond allocation back into equities, the term deposits, and insurance institutional money. So we actually think that this is a healthy move to actually contain the sentiment a little bit, but it should not be really fundamentally disruptive to the A-share market sentiment at the moment. With that, I'll hand it back to Crystal. Thank you.
Thank you very much, Flora. And then last but not least, we have Jenny online, and then the China econ team, they have upgraded their forecast for the currency. Can you talk about your views and also the sentiment tracker?
Hi, everyone. Happy New Year. So for China, we can see 2026 marks a very strong start with the infrastructure push, renminbi appreciation, and stock market rally. Then over the past week, the key investor questions we have got is whether such strength can be sustained and how long it can last. We think China's real GDP growth can be lifted from around 4.5% last quarter to close to 5% in the first quarter of this year on a stronger public capex. And we think the USD CNY can each lower toward 6.85 on strong exports and weak dollar. But domestic demand weakness and the persistent deflation will still keep the upside. Then if we zoom in on the growth, we see very strong signs of the public capex front loading. Both the advanced central budget for infrastructure and the local government debt issuance plan for the first quarter are 50% higher than the same period last year. And if we look at the high frequency data, we can also see like the Siemens shipment has shown a stronger than seasonal rebound and the margin. But on the other hand, we need to see that the consumption has remained subdued given the weak wage growth and the increased negative wealth effect from the continued housing downturn. And overall policy has remained quite supply-centric and reactive. And we only see the continuation of the cash for clunker program, but there's no a stronger support for consumption, and also we cannot see the signs of additional support for the housing market in the next couple of months. And therefore, we believe that even if the first quarter real GDP growth can pick up to around 5%, this cannot be sustained. Then on inflation, some investors are taking the recent CPI and PPI improvement as a sign of a nascent reflation. But if we look at the data breakdown, you can see the recent uptick has been mainly driven by higher prices in like gold, food, and some upstream sectors. But sequential price growth in core CPI excluding gold and the downstream PPI has remained soft. And we think this actually is a better reflection of the final demand, and it's still very weak. And given the continued supply-demand imbalance and slow policy move to support the property market and service consumption, we think this year is just a year of less deflation rather than reflation. Then last on renminbi, yes, we recently upgrade our forecast path and see the USD CNY can reach 6.85 by end March. This is a mark-to-market adjustment to recognize the China's stronger than expected exports and dollar weakness. But we are more conservative than the market on the renminbi performance beyond Q1, and we think the USD CNY can fall back to 7 by year end. And that is based on two reasons. First is that we believe the dollar weakness is just temporary. The stronger than expected US economic growth and the slowing Fed rate cut pace may lead to dollar rebound in coming quarters, and they will put the downward pressures on the USD CNY. And also, we think a more fundamental reason is that although we remain constructive on China's export this year, the export alone is insufficient to justify a sustained renminbi depreciation, because from the left-hand side chart, you can see here. On the left-hand side chart, you can see that China still have the capital outflows amid the deflation. The continued deflation would drag on China's asset returns and reduce their attractiveness to foreign investors. It improved a bit last year, but it still remains the case that the renminbi asset has a relatively low return as compared to assets in other countries. And Japan's experience in 1990s also tell PBOC that the currency appreciation should be the result rather than the driver for the economic rebalancing, because it will hurt the export growth, and that is one of the very few growth drivers left in the economy for now. And weaker exports will also lead to weaker wage growth slowdown and just worsen the deflationary pressures. And therefore, we believe the PBOC will allow modest renminbi appreciation against the dollar when dollar is weak. But in the meanwhile, it will keep the renminbi CFA basket largely stable. And to this end, we can see from the right-hand side chart that over the past months, the PBOC has been very rarely adopting the counter-cyclical factor for the CNY fixing to control the pace of appreciation. So what is the way out? We think the key will remain on more policy efforts to help to rebalance the economy. In our base case, we assume that Beijing will consider the mortgage interest subsidies post the March MPC, and they may also think about the service consumption vouchers in the second half of this year. But they will start with pilot programs. But if the social dynamic accelerate the deterioration due to the deterioration of the deflation, then it could push for faster and stronger policy actions to ensure the social stability. Yeah, let me stop here and then hand over to Crystal. Thank you.
Thank you very much, Jenny. And then now we will move on to the Q&A session. John, if you still have the time, just one question here for you. So do you see a rotation among markets and sectors for 2026? And then because so far year to date, what have outperformed is quite similar to last year.
Yeah, that's a fair comment, that the performance trends from last year are continuing. Well, to be clear, the performance trends for the year as a whole, there was actually a very meaningful correction, for example, in defense stocks in the fourth quarter. So we had a lot of questions about that, about whether that outperformance would resume. And obviously around Liberation Day, there was a huge reversal in semiconductor stocks. So yes, broadly speaking, things are continuing on the same path as last year. Energy was the key sector underperformer last year. In terms of our own views, we're recommending quite tight market risk positions, a slight preference for Japan over EM. Japan's performance has actually accelerated in terms of outperformance at EM in the last few days as Takeichi Sane is moving towards calling a snap election, and the market typically trades well in the run-up to snap elections. So that's certainly worth watching. We'll try to keep you posted. We're making some quite strong stock calls in our various focus lists, including the newly launched thematic list. It's going to be a year when one has to be nimble to maintain this overall robust approach. Thank you.
Thanks, Jonathan. And then there are several questions for Rajiv on the line as well. I will just ask them one by one, perhaps. The first one is that you have been mentioning that delay in tariff impacts has been quite significant given the freight time also inventory. So how much of the current inflation, which is still elevated, is caused by that? And then how much is the underlying strength of the consumer?
Hey, Crystal. No, so that's a great question, and it's key to what's going to happen also, because we should be getting a Supreme Court ruling on IEEPA tariffs very soon. Our general, the way I like to think about it, I mean, we've been tracking it, and if you go into, there's there's a fellow named Diego Anzotegui, and if you go into the Morgan Stanley website, he's our inflation modeler, and he works with our chief U.S. economist, Michael Gapin, and you can get into all sorts of detail on our published research. But at a high level, the way I think about it is U.S. core inflation is probably running closer to 2.5. And as you saw in the last print, we were around 2.7. We think that goes, the PCE implication of that is 2.8. And it could go up to 2.9 over the next few months. So I would suspect that 20 to 30 basis points of the push that we've seen over the past few months is really led by tariffs. And so the Supreme Court, and our general expectation is that starts to fade by the end of Q2. And so that's why we have the Fed cutting in June, is that by that point, you'll have seen the top of the inflation from the tariffs, and you start to move towards 2.5 inflation level rather than the kind of just below 3 where we're sitting at. Now, if IEEPA is ruled illegal, the shape of that ruling could affect the timing of that. And so I think that'll be a very important thing to watch early next week. But that's the way we're thinking about it.
Thanks, Rajiv. And then the second one is, so if you get the new Fed chair, what's the implications on the rate path from here?
So this is the other reason I think the court rulings really, really matter. You know, the subpoena of Jay Powell last week was pretty historically unprecedented. And Senator Tom Tillis, who's senior member of the Banking Committee, has suggested that they won't push any Fed nominees until this subpoena is resolved. So I don't know if that's true, but the point being, this is a reflection of the tension that exists in the U.S. and in Washington, D.C. about whether or not they nominate a Fed chair who is deemed to be independent. Now, clearly, if a Fed chair that is a little bit less independent is placed, then there are risks to rates. But as we've written in the past, there are a lot of institutional safeguards at the Federal Reserve that make that a low probability case in the next 1 or 2 quarters. Obviously, the risks increase if there's more power given to, by the Supreme Court to the administration to change different governors. But for now, the institutional safeguards are in place. And so our baseline scenario is that we do not get somebody that is just going to do things politically. And this is why, from a technical economic standpoint, what I was discussing before about productivity or not is very, very important. Because if we are in the midst of a productivity boom, there's a very sound, rational economic explanation to cut rates. So that's why, independent of who the Fed chair is, the data over the next couple of quarters is going to be really important. Because if we're in an aggregate demand-led world, that creates one path for interest rates. If we're in a productivity-led world, then that creates a different path for interest rates. And that's really what we were trying to present in those 2 scenarios that I used in my image when I started this presentation.
Thanks, Rajiv. And then we still have 2 questions for you, and then I would just probably ask them together. Trump seems to be very focused on the housing affordability, and then how does it impact growth and inflation? And then the last question for you is, how is consumption trending in US? And then have consumers felt the hurt from the elevated inflation?
So I'll do the latter one first. So inflation, consumption is tracking just around 2% in the U.S. This is a deceleration from Q3, but it's still strong consumption. The problem is that we're getting a lot of noisy data during the government shutdown, and like retail sales, which was surprised to the upside yesterday, is printed in nominal terms. And so we really need to see kind of what the PCE is in order to understand the real component. But generally speaking, we're tracking around 2% consumption right now, which is a healthy level. And the consumer is feeling, you can see in the disaggregation of that consumption pattern, that the consumer does feel the tariffs, and they're consuming less stuff that are tariffed and more stuff that isn't, i.e. services. But the bigger question I think that a lot of people are asking away from tariffs is what the fiscal implication could be next year, and whether or not fiscal stimulus will move the needle. You know, our baseline is that on the margin, it's supportive to the U.S. economy, but we still have a lot of pluses and minuses to think about for what a fiscal stimulus could mean in Q1 with the tax. So the tax cuts that are coming are for overtime work and for people that are waiters, that they get their tips taxed. That's not really going to move the needle that much. The thing that's really going to be stimulative in Q1 is the tax breaks that corporates receive. Although on the margin, the consumer should be in a slightly better place, though not anything like we saw in the 2017 tax cuts. So overall, the consumer's in a decent place, but there's a lot of bifurcation in terms of what consumers are consuming and which consumers are consuming. So we do have a lot of published research on that, which we can follow up on later. In terms of housing, we saw some upside surprise in the housing data yesterday, but overall, the big picture is that the housing is likely to continue to stagnate. Jay Bacow and Jim Egan, who are kind of U.S. gurus on housing, have indicated that we still need many more basis points, like over 100 basis points of compression in mortgage rates to really get supply and demand to clear at a clearing level. And clearly the administration is working to try and find solutions to get in that direction, but we're still not there yet. So right now we're expecting, very modest housing activity in the U.S.
Thanks very much, Rajiv, and thanks for your time today. And then next we'll move to the questions on China, and then the first several questions are for Laura. The client is asking whether we should expect the Hong Kong market to catch up to A-share in the near term, and then what catalyst should people be watching for the Hong Kong LT market. And then the second one is the earning revision breadth seems to have dropped down to slightly above zero, and then what have dropped down the earning revision in terms of the sector composition. And then the last one is, I know that there is a lot of interest during your US marketing, but then have the real money come into China? And then if not, what are the key bottleneck that are stopping investors? And if yes, what people are buying?
Thanks very much, Crystal, and thanks to the investors who raised these very good and valuable questions. So the first one, how do we think about Hong Kong versus the Asia market? With the margin financing tightening measures that came out yesterday, I think that the Asia market could potentially take a temporary breath and take a little bit of break. If you look at how the onshore market has been doing today versus Hong Kong, it's actually slightly dropping more than the Hong Kong market. So that could potentially give Hong Kong a chance to catch up. That being said, as I mentioned earlier, I think the liquidity support for the onshore, I would say from a scale perspective, it seems to be bigger versus what we can see for Hong Kong at the moment. And also, let's not forget how last year Hong Kong actually had outperformed the Asia market. So what we're seeing at the moment is really just a catch-up game that A-share market is playing against the Hong Kong. If we look at this whole rally that started last year, but not if we do not only look at from the beginning of this year. I think on a 6 to 12 months basis, we actually think both markets would perform relatively on par, with Asia market offering unique opportunity sets, as I mentioned earlier, and the strong liquidity support. Whereas for Hong Kong, I think given the relatively underweight positioning by global investors on Chinese equities, Hong Kong and the ADR space would still remain the first stop for global investors to build up their China exposure. So I think, and also the Hong Kong offers also a lot of large cap, highly liquid names with AI exposure and with new consumption exposure, etc. And particularly if you are a long-only or mutual fund long-term investors, you also want to think about some of the good high-quality dividend plays that Hong Kong actually offers very good value for these stocks that are both listed in Hong Kong and A-shares, and with the H-share being valued at a more attractive price. So I think on a 6 to 12 months basis, we reiterate we expect both markets to perform relatively on par. Earnings revisions, yes. So China's earnings revision turned positive for the first time in 3.5 years back in August last year, but that momentum has slowed down. It's still above zero. It's still positive, which means we are having more positive upward earnings revisions than downward revisions. But yes, the momentum has slowed down. This is mostly triggered, in our opinion, by some of these large internet e-commerce players who have been engaged deeply in price wars since mid last year, and that had caused severe earnings expectation reduction, particularly in the consumer discretionary / internet e-commerce sector. And with the government shifting their focus back on anti-involution, we already are seeing a number of announcements and documents being released over the course of the last week. So hopefully the supply demand dynamics can be rebalanced faster, particularly in this